In this module, we're going to be covering just a basic overview of bonds and the initial journal entries needed to set up a bond for the first time. So just as an overview, when a company decides to start up operations or expand, they have to obtain financing from one source or another. Certainly they can invest their own money. Some companies decide to go borrow money, and some companies decide to issue stock to get other owners to share their investments in the company. This is going to focus mostly on bonds, but we will talk about a little bit of the difference between debt financing, like bonds, and equity financing, like stock. With debt financing, what you are doing is borrowing money. This could be from a bank, or this could be from bondholders, which would be basically borrowing from several individuals. You could also decide to issue stock, which means that you now have owners investing in the company. They are now part owner. They take on the risks of any other owner. Some of the benefits of borrowing through debt versus by issuing stock, a benefit of debt financing is that you no longer need to share the profits with other owners. The only thing you have to pay in that case is interest, and that could be it's going to be a fixed amount. Now, if you have a considerably good year, you don't have to share any of those excess profits with the other owners. Another benefit of debt financing is that it does not impact the current ownership shares. So whatever percentage of ownership one stock was worth before, if you issue bonds, that won't impact that percentage. If an owner currently owns 10% and then the company decides to go issue bonds, that doesn't impact the 10% ownership that that owner had. It also means there are no additional owners to control the company. So when we talk about voting rights and all of that, the bondholders do not have that power. A big benefit of bond or debt financing is that you pay interest. That interest expense is tax deductible. Now, that doesn't mean you get it all back through the tax return, but it's a deductible expense. It helps to reduce your tax burden a little bit. Another big benefit for debt financing is the potential for an increased return on equity. Now, we haven't covered the ratios in this module, but return on equity is looking from an owner's perspective. They're looking at the investments they had to make, so all of the equity investments, comparing to what net income is coming back. Now, what this means at a high level, if done right, if you borrow at a low interest rate, and then you're able to, let's say you borrow at 5%, you're able to take that money and invest it and generate a 7 or 8% return, you now have what's known as positive financial leverage. Theoretically, if you could do that guaranteed at higher amounts, you'd want to continue to do that forever. If you could borrow at 5% and invest and return at 8%, for example, you have that 3% difference that is profit for you. Now, the drawbacks of debt financing, first of all, you have a set interest payment you have to make every period. There's no question about it. It's not like a dividend with ownership where you can make a decision as to whether to declare dividends. Interest is locked in. You're contractually obligated, and if you decide not to pay, those bondholders could possibly force you into bankruptcy. The other drawback is that you have that lump sum payment due at maturity. Even though you may not be paying any principal along the way, that full principal, that full face value is due at maturity. A big drawback for debt financing is that it's the flip side of what we just talked about. There's the potential for decreased return on equity as well. If you borrow at 5% and you're only able to generate a 3% return, you're losing money with every dollar you've borrowed. That's called negative financial leverage. So the issuance of the bond itself. We have to look at the price of the bond versus the face value of the bond. In another module, we discuss the specific difference between those two, but basically it boils down to comparisons between the stated interest rate that is actually being paid on that bond versus the market interest rate, which is an average payment from other bonds of similar risk. The stated rate has a few other names to it: coupon rate, contract rate. It basically reflects the rate of interest the company is paying. The market rate, sometimes referred to as the effective rate or the yield, is an average rate that other companies are paying for interest. Now, you may question, why is there a difference? A lot of that difference really boils down to just timing. There's a lot of legal work that goes behind developing a bond, issuing a bond. So in many cases, a certain rate was locked into the contract, and that may very well have been the going rate at that point. But then a little bit of time passes before the bond is actually issued, and by the time it's issued, the market rates have increased or decreased. So there's a difference in the two rates. Not a big deal there. So let's briefly look at the journal entries for the first issuance of a bond. The first example is the simple one when the bond is issued at par. This is where the stated rate equals the market rate. And what we have to do here is debit cash for the amount received. We're increasing our company's cash. In this case, it's $100,000. We would also be crediting bonds payable to show that we owe $100,000 in the future. That's our journal entry for the initial issuance. Again, we'll be discussing the interest payment, the retirement of the bonds in later modules. But now let's take a look at the example where the bond was issued at a discount. So here is where the stated rate is less than the market rate. In other words, we are paying less than other companies are paying on average. So what we have to do here is we're debiting cash for a smaller amount than what the face value of the bond is, because we're not receiving the full amount. In this example, we only have $95,000 of cash coming in. So we're debiting cash for that. We're going to credit bonds payable for $100,000 because that's the face value. That is what will be owed in the future. But we're $5,000 short on the debit side. That $5,000 goes to an account sometimes referred to as discount on bonds payable. It is a contra liability account, which means it offsets the liability account. A liability account has a normal credit balance, but a contra liability account will have the opposite normal balance. It'll have a debit balance. So by debiting this discount, we are increasing the contra liability account, but indirectly, as we'll see in a few slides, on the balance sheet, this offsets the value of that bond. So we'll see that in just a bit. But first, let's look at the opposite situation where we have an issuance at premium. This means the stated rate that we are paying interest at is more than the market rate where the average interest payment is. So what we would do here is we would be debiting cash for a higher amount. In this example, $105,000. Our bonds payable would still just be $100,000 credit. The premium is going to be on the credit side in this case for $5,000. What that means is that we had a premium on bonds payable. That's known as an adjunct liability account or accretion account. And that basically means we're adding to the value of that bond. So on the balance sheet, it's going to have a higher value than just $100,000. This is an example of what this may look like on the balance sheet. We have the bonds payable, and I'm using a discount example here. Bonds payable less unamortized discount of $3,000 gives us a net carrying value of $25,000. That's the amount that's really going to matter, the $25,000. Now, one thing I will mention, and we'll see this more in later modules, over time, that carrying value will be either increased or decreased to get closer and closer to the bond face value. By the time of maturity, they should be the same. Now, that Again, we're going to discuss that in the interest expense entry module later on. But the reason that happens is that that unamortized discount or unamortized premium gets used up period after period until it's eventually zero, which means our carrying value of the bond would equal the face value of the bond. Now, just as a brief introduction to interest expense, we have to amortize that premium or discount each period. What we'll find when we look at the interest expense in more detail is that the premium, when we use that up over time, it's going to decrease interest expense. So when I say that, I mean it's going to decrease the interest expense that we record, so it's less than the actual cash interest paid that period. The discount will do the opposite. It will increase the interest expense above the actual cash interest paid. So that's just a brief introduction. We're going to see the details in a separate module, how that all works out, what the journal entry looks like, why it works that way. And that wraps up our discussion for this introductory journal entry module.